Crypto futures are contracts. These contracts let you bet on the future price of a cryptocurrency. You don't actually own the cryptocurrency, you are simply speculating on its price movements. If you think the price will go up, you buy a futures contract. This is called going long. If you think the price will go down, you sell a futures contract. This is called going short. Futures contracts are settled at a specific date in the future. This is called the expiry date. On the expiry date, the contract is settled and you either make or lose money depending on the price of the cryptocurrency. Crypto futures are a type of derivative. Derivatives are financial instruments that derive their value from an underlying asset. In the case of crypto futures, the underlying asset is a cryptocurrency. Futures trading is a complex topic. It is important to understand the risks involved before you start trading. Crypto futures trading can be very appealing, especially to beginners. One reason is the potential for high profits. Futures contracts offer leverage. Leverage allows you to trade with more money than you have in your account. This can amplify your profits. However, it is important to remember that leverage also amplifies your losses. This aspect of leverage is often overlooked by new traders. Another reason why crypto futures trading is appealing is that it allows you to profit from both rising and falling markets. If you think the price of a cryptocurrency is going to go up, you can buy a futures contract. If you think the price is going to go down, you can sell a futures contract. While crypto futures trading can be profitable, it is important to remember that it is also very risky. The cryptocurrency market is highly volatile. This means that prices can move very quickly and unexpectedly. This volatility makes it difficult to predict which way the market will move. Only a small percentage of crypto futures traders are actually profitable. This is because futures trading is very complex and requires a deep understanding of the market. Many new traders underestimate the risks involved and end up losing money. It is important to remember that leverage can amplify your losses just as easily as it can amplify your profits. Leverage allows traders to control a larger position in a futures contract with a smaller amount of capital. This can be a powerful tool for amplifying profits. However, it is crucial to understand that leverage is a double-edged sword. Let's illustrate with an example. Imagine you have $1,000 to trade Bitcoin futures. You believe the price of Bitcoin will rise. With 10 times leverage, you can control a contract worth $10,000, 10 times your initial capital. If Bitcoin's price increases by 5%, your profit would be $500, 5% of $10,000. Without leverage, your profit would have been only $50, 5% of $1,000. However, the reverse is also true. If Bitcoin's price drops by 5%, you would lose $500, wiping out half of your initial capital. Without leverage, you would have only lost $50. Section 5. Navigating crypto futures platforms. Several platforms offer crypto futures trading. Some of the most popular platforms include Binance, KuCoin, and BitGet. Each platform has its own strengths and weaknesses. Binance is the largest cryptocurrency exchange in the world by trading volume. It offers a wide variety of futures contracts with high liquidity. KuCoin is another popular exchange that offers a user-friendly interface and a wide range of features. BitGet is known for its copy trading feature, which allows users to automatically copy the trades of more experienced traders. While these platforms offer similar services, their fee structures, trading interfaces, and available features can vary. It's essential to research and compare these platforms to find one that suits your trading style and risk tolerance. Section 6. The perils of leverage. Liquidation and margin calls. Two significant risks associated with leverage are liquidation and margin calls. Liquidation occurs when your losses are so large that your position is automatically closed by the exchange to prevent further losses. A margin call happens when the value of your account falls below a certain level, the maintenance margin. When this happens, the exchange will require you to deposit more funds into your account to cover potential losses. This deposit is called a margin call. These situations can arise quickly, especially in the volatile crypto market. A sudden price swing against your position, even if temporary, can trigger a margin call or even a liquidation. Understanding these risks is crucial before engaging in leveraged trading. Section 7. The importance of technical analysis in futures trading. Technical analysis is a crucial skill for futures traders. It involves studying historical price charts and using technical indicators to try and predict future price movements. Traders use various tools and strategies including chart patterns, candlestick analysis, and indicators like moving averages and Bollinger Bands to identify potential trading opportunities. Before entering any trade, it's crucial to have a clear understanding of why you are entering the trade, where your stop loss will be, the price at which you will exit the trade to limit your losses, and what your profit target is. Section 8. Starting safely. Small trades and limit orders. When starting with crypto futures trading, it is essential to start small. Only trade with an amount of money you can afford to lose. As you gain experience and confidence, you can gradually increase your position sizes. Another essential tip is to use limit orders. A limit order is an order to buy or sell a futures contract at a specific price or better. This gives you more control over your trades and can help to prevent you from making impulsive decisions. Remember, every trade involves risk. Starting small and using limit orders are two ways to manage and minimize those risks. Section 9. Beware of social media illusions. Social media is rife with misleading information about crypto futures trading. Many posts boast of incredible profits, often accompanied by impressive-looking screenshots. However, these posts rarely show the full picture. The reality is that most successful traders experience losses along the way. It's easy to highlight wins and hide losses on social media. Do not base your trading decisions on what you see others claiming online. Focus on learning and understanding the market yourself. Don't be swayed by social media hype. Remember, consistent profitability in crypto futures trading requires time, effort, and a deep understanding of the markets.